Hi everyone. We are going to go through two practice problems, problem 618A and problem 621A. So we have here on page 282, Haas Company manufactures and sells one product. The following information pertains to each of the company's first 3 years of operations. Their variable cost per unit listed, fixed costs. During the first year of operations, Haas produces 60,000 units and sold 60,000. During the second, it produces 75 but only sold 50. And then the third year produces 40 and sells 65. The selling price is $58 per unit. First thing they'd like us to do is compute the company's break-even point in units sold. So the break-even point can be found by taking the selling price of 58 minus the variable cost per unit of 38. So that would be the 20 of direct materials plus the 12 of direct labor plus the 4 of variable manufacturing overhead and the 2 of variable selling and administrative. So take the fixed cost of 1.2 million, which is the 960,000 plus 240, and divide it by your contribution margin per unit of $20 to get 60,000 units. Okay, so that's how we found, like we saw in the last chapter. Now assume the company uses variable costing. Compute the unit product cost for years 1, 2, and 3. Well, remember, under variable costing, we to determine the unit cost, we take the direct materials plus the direct labor plus the variable manufacturing overhead. And that gives us our variable costing unit product cost. We don't do anything with fixed manufacturing overhead or selling and administrative expenses. And so you could see the explanation down below. Just a reminder about selling and administrative costs. In part 3, now they want us to create an income statement for each year under the assumption of variable costing. Well, we'll take our sales for each year times the sale price per unit. So the first year they sold 60,000 units times $58 should get 3,480,000. In year 2, they sold 50,000 units times $58, 2.9. And then in year 3, they sold 65,000 units times $58. Take the number of units sold times the cost per unit, variable cost of goods sold, under variable costing, which is $36 per unit, which we just calculated. And you get 2,160,000 for year 1. You'll do the same thing using the units sold times the $36 for the year 2 and year 3 amounts. You just have to remember how many were sold. Be careful. Not produced, but sold. The next section we're doing a variable costing income statement. So although it isn't a product cost, we still subtract the selling and administrative because it's a variable expense based on the number of units sold. So 60,000 times 2 would be 120, then 50,000 times 2, 100,000, and then 65,000 times 2, 130. So then we add those two together to get our total variable expenses for each year, and then subtract that amount from sales to get your contribution margin for each year. We then subtract our fixed manufacturing overhead and our fixed selling and administrative expenses. Remember, in a variable costing income statement, we group variable expenses together and fixed expenses together. And that will result in year 1 having a 0 operating profit, year 2, when we subtract those fixed expenses, a $200,000 loss, and then in year 3, a $100,000 income. Okay. Now we're going to go and look at the same information, but assume absorption costing. Now remember, when it comes to absorption costing, we include fixed manufacturing overhead to determine the unit product cost. So we'll do direct labor, direct materials, variable manufacturing overhead, and fixed. Now each year, you'll divide the number of units produced into the fixed cost, not the number sold, the number produced, because that's what is related to the fixed costs, the production. So the first year, your fixed cost per unit is $16, but the second year, since there's 75,000 produced, it's $12.80 per unit. And then in the third year, when only 40,000 is produced, it's $24 per unit. So each year you have a different unit cost. So now when we do an income statement under absorption costing, our sales will be the amount sold times the $58. The cost of goods sold will be the amount sold times the unit cost for that year. So in year one, it was $52 per unit, 60,000 times $52. In year two, when we sold 50,000 units, it's $48.80 per unit. Now, what you have to be careful of, not all the items that were produced where the unit cost is $48.80 were sold in year two. 25,000 of them are sold in year three. So part of year three's units sold will be the 25,000 that weren't sold at the end of year two. Their cost of goods sold is determined under their unit cost, $48.80, when they were produced. The remaining 40,000 will be under the third year's unit cost. So you got to be careful of that in absorption costing when you're expensing the items that were sold. If there were items not sold in the prior period, so there's ending inventory, that ending inventory amount, when it is sold in the next year, must be removed or determine their cost of goods sold by the cost per unit to produce that. So now you could see how we determine the cost of goods sold under each of the scenarios. The gross margin is $360,000 for year one. Selling and administrative expenses. Now, how do we get that, right? Well, remember, there's $240,000 in fixed. If we sell 60,000 units times $2 variable cost per unit for selling and administrative, that's $120 plus the $240,000. So this number changes because the variable cost changes based on how many were produced. So in the second year, I think there was 75. Oh no, I'm sorry, based on the number sold. 50,000 times 2 will be 100,000. So 100,000 would be your variable selling expenses, because that's based, this computation is based on the number sold, plus the 240 fixed. Year two's 340, and then you would do the same computation in year three when 65,000 are sold. 65,000 times 2 is 130, plus the 240 gives you 370. And that will result in your net operating income and loss as listed. Now in part 4, they say compare the net operating income figures that you just computed in requirements 2 and 3 to the break-even point that you computed in requirement 1. Which net operating income figures seem counterintuitive, and why? So in year 1, it says the break-even is 60. Okay, and we sold 60, so 0. In year 2, the break-even, the units sold were 50. Break-even in units are 100,000 or 10,000 would be below were sold. And then in year 3, 5,000 more were sold than the break-even. So in year 2, when 10,000 less are sold than the break even, you would think it would produce a net loss. And vice versa in year 3, when there's 5,000 more sold than break even, that should indicate a profit. Well, under variable costing, that is the result, but not under absorption costing. So absorption costing is the one that seems counterintuitive. In year 2, the number of units sold is below the break even. However, absorption costing is reporting an income. And in year 3, it's above, and now it's reporting a loss. Okay, and that's because of the way we're removing the costing. Okay, so that is practice problem 18A. Now we're going to move on, and we're going to look at practice problem 621A. Let me get there. Here, there we go. Okay. So in 621A, we're going to look at segment reporting, which is the other major part of your chapter. Vulcan Company's contribution format statement for June is below. So they give us sales for the entire company, variable expenses, fixed expenses, and net operating income. Management is disappointed with the company's performance and wondering why. What can be done to improve profits? So they start examining the sales and cost records. And the company is divided into 2 sales territories, Northern and Southern. And you can see that listed there. The Northern Territory recorded sales of $300,000, variable expenses of $156,000 during June. The remaining sales and variable expenses were recorded in the Southern Territory. Fixed expenses of $120,000 and $108,000 are traceable to Northern and Southern, respectively. The rest of the fixed expenses are common to the 2 territories. Now, the first step you could see there is prepare the contribution format segmented income statement, first showing total company broken down between sales territories, and then showing Northern Territory broken down by product line. In addition, for the company as a whole, and for each segment, show each item on the segmented income statement as a percentage of sales. So here is the first step, okay? Total company income. They give us the information to create our contribution format segmented income statement. So Northern, $300,000 in sales. Southern has the remaining $450,000. We know total sales. Variable expenses are $156,000 for Northern, total are $336,000, so the other $180,000 is attributed to Southern. Contribution margin you calculate. Traceable fixed expenses are given, $120,000 for Northern, $108,000 for Southern. Subtract those and you get the territorial segment margin, or the segment margin for each territory. $162,000 for Southern, $24,000 for Northern, total $186,000. The remaining fixed expenses are common. How do we get that? Well, the total fixed expenses are $378,000 for the company. $228,000 of them are traceable. So the remaining are common. Now, in Part B, it tells us information specifically about packs and tips, 2 product lines of Northern. And we have to now break Northern down further using this information. So packs and tips have $50,000 and $250,000 in sales, respectively. You can see them listed there. Their variable expenses are 22% of the selling price for packs and 58% for tips. So in this one, they give us the percentage. So we must calculate that amount. 50,000 times 22% will give us 11,000 variable expenses for packs. 58% of 250,000 gives us the variable expenses for tips. Subtract that to get your contribution margin. It then gives us the traceable fixed costs for each one. 30,000 to Northern, 30,000 to packs and 40,000 to tips. I'm trying to read it. And then the remainder of any fixed costs associated with the Northern Territory, which is 120, is common. So this is the resulting income, contribution income statements. So remember, each of these items are a percentage of sales. So if we look at the total company to come up with our percentages, we'll take 336 divided by 750. 414 on the contribution margin divided by 750,000 will give us 55.2%. Traceable fixed expenses, 228 divided by 750, 30.4. Territorial segment margin, 186,000 divided by 750, 24.8. Common fixed expenses of 150 divided by 750, 20%. And then finally, your net operating income of 36,000 divided by 750,000, 4.8. So that is how you come up with those percentages for each of these. Now, in the product lines, they gave us the variable expense percentages. So you could calculate them, but they're given. Okay, so that is how you complete that part of the problem. Now look at the statement you have prepared. Showing the total company segmented by sales territory, what insights revealed by the statement should be brought to the attention of management? 2 insights. First, compared to the Southern Territory, the Northern Territory has a low contribution margin ratio. So let's take a look. Southern 40, Northern 52. Interesting. Second, the Northern Territory has higher traceable fixed expenses. Overall, compared to the Southern Territory, the Northern Territory is very weak. Fixed expenses, fixed expenses. But look at the ultimate amount of segment margin. Southern 36%, Northern 8%. Now, look at these statements for the Northern Territory segmented by the product lines. What do you see there? So you're going to do that same kind. Take a look at the variable expenses. Tibbs is 58%, where PAX is only 22%. But then look at the traceable expenses, 60% to PAX, 16% to Tibbs. PAX ends up being the weaker of the 2 lines, it looks like. Okay, so again, 2 insights. First, the Northern Territory has a poor sales mix. Note that the territory sells very little of the PAX product, which has a high contribution margin. Take a look. Yeah, look at 78% contribution margin, and it sells 50,000 of, I don't know what a PAX is, but that is something to bring to their attention. Note that the territory sells very little of the PAX product, okay? This poor sales mix accounts for the overall low contribution margin ratio in the Northern Territory, so that could help improve Northern Territory's position in the company. Second, traceable fixed expenses of PAX seem very high in relations to sales. It may mean that the PAX product is highly leveraged. If so, then an increase in sales of this product line would enhance the product in the Northern Territory. So it looks like this PAX is where the problem lies. They need to focus their attention there because they have a great contribution margin that they need to increase the number of sales to cover these fixed expenses, because right now their traceable fixed expenses are a high percentage of sales, 60%. So if they increase sales, remember fixed costs are going to remain constant. So if they increase this even to 100,000, they just decrease this product line percentage to 30%. Okay, so this is how companies will use their segmented information to make management decisions. And that's the key to learning about this. Managerial accounting. What do we do in accounting for managerial decisions? Okay, so that ends our practice problems. If you have any kind of questions, please post them to the discussion board.